While leading integrated poultry producer Astral Foods reported interim results showing a 5% rise in revenue to 4.2 billion rand. This coupled with an 82% decline in headline earnings per share to 94 cents. We spoke to Astral Foods CEO Schutte to unpack the numbers.
Here's no surprise to us, the past 6 months, the worst results that we've reported on in Astral, and that is mainly driven by the higher input costs. So maize and soya peaked during this period, and it was very difficult for us to recover it in a market that was already depressed. And on top of our depressed consumer market, we also saw imports of chicken into this country peaking during October and November, which didn't allow us the opportunity to recover our input cost in December. So maize prices on the back of a huge American drought. Some people talk about a 50-year worst crop, and together with that, soya prices peaking, had a move of 850 rand per ton of feed into our poultry division, and that knocked off about 300 million rand off our bottom line.
So the business under pressure and certainly making you less competitive is the fact that you've increased selling prices. We've seen that up just over 6%, and as a result, revenue raked in was able to climb 5%. To what extent do you have to now look at the option of cutting to cost, keeping prices down to get volume through, and reaping some of that revenue from volume as opposed to price?
Our volume is very important in a volume business like ours, or in a commodity business. And if you touch your volumes or you want to reduce volumes, it's got a direct impact on your fixed cost. So that is one of the last things you would like to do. What we have seen over the past couple of months from January onwards, especially with a weaker rand, that imports have pulled back a bit. And at the same time, I think there was a general cut in production in this country from producers. And so did we. We cut back volumes by about 5%. But that negative impact, obviously, in your fixed cost. But we have to, going into the winter, monitor stock levels and pricing very carefully. Otherwise, you will have a stock build-up, and you will just have to reduce prices or your promotional activity again later during the year to move those volumes.
In fact, we have seen some of that increased promotional activity come through over the period. So talk us through that and to what extent it managed to alleviate some of the pressure.
First of all, poultry has got a very long lag time. So if you want to change the number of birds that you slaughter, the decision to cut back on that has to take place about 4 months earlier. So it's not a quick change you can make, and if you do it, you have to make sure that you do it over the right period of time to reduce your cost. So we would plan specifically not to slaughter on a public holiday, because that's normally where you pay double wages. But that decision has to take place 4 months earlier. So we've done a bit of that. But at the same time, we've also seen unemployment rise to a new record level. So the pool for product in this country was not where we would have liked it to be. And of course, at the same time, imports peaking during October, November. And the number of imports into this country in November was the equivalent of about 8 million birds that we would slaughter a week. But the promotional activity is normally just to move your stock. We don't have the ability in this country to stock more than about 7 or 8 days production, which is a very small number of chicken, but the frozen capacity in this country is simply not there to stock more than that. So once the pipeline are full with chicken, you have to promote it and get the housewife to physically get into the store more often, buy more chicken, and not just buy it, but also eat it. Otherwise, you just keep on filling up the pipeline.
So that's the context in South Africa. Let's take a look at what you're looking at when it comes to your rest of Africa operations. First of all, what kind of demand are you seeing on that end? And secondly, are you having to deal with the dumping of cheaper imports in those territories as much as you're dealing with them within South Africa's borders?
That's one of the arguments we have through our application to the DTI via ITEC, is that most of the countries protect their industries, especially when it comes to food production. So those countries where we operate, like Mozambique and Zambia, they've got protection in those countries. Even Namibia, Zimbabwe and Botswana have got protection for their local industry. It is only in South Africa where we have very liberal trade barriers that we are not protected. Even some of the South American countries are protected and heavily protected against imports. So in Zambia we're expanding our business, in Mozambique we're expanding, and we currently have a lot of recce's around the southern part.
So at the moment you're better positioned in Africa?
Well, our margins there is profitable, and it's about double the margin here. And it's purely because those industries are slightly more protected, and also the per capita consumption is very low, so there's still a good pull for our product in those countries.
Chris, if you get no relief from government here, could you go out of business? To what extent does your survival stand at risk?
Well, if I look at the industry and not just at Astral, we've seen 7 small to medium companies go out of business over the past 18 months. So already you can see the detrimental effect it has got on the industry. It is the guys with a stronger balance sheet that will last. And I think Astral is one of those companies. Besides all the bad trading environment over the past 18 months, our debt to equity ratio is still below 20%. So we're in a good position to avoid going under. But the industry as a whole is in trouble in the long run.
In the interim, while we wait for government to come through with what you're calling more effective policy, you've been taking measures internally. You've frozen wages late last year, for example. How stable a stance is that? And I guess one of the other big questions around that is, did management do the same?
Yeah, it was not a popular decision, but I still firmly believe it was the right thing at the right time. And yes, management has also not taken any salary increases. And I don't think you can do it more than once, but we did it because it was the right thing at the right time. It was either that or cutting jobs, and we had to make that decision. As I say, not very popular, but rather that than cutting 500 or 1,000 jobs out of our business.
If nothing happens on the regulatory front, what do you see the company reporting in 6 months' time?
Well, 2 things that will happen. I think the rand in the meantime will assist us a bit, the weakness in the rand, a bit with the high levels of imports. And then second to that, we've also seen a pullback in raw material prices. So we'll get some assistance from a lower level of feed cost, and that could pull the poultry part of our business back to a break-even point out of a loss-making situation.